Joining me now is Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Always great to see you.
Good to see you, Mark. It's been a year.
It's been a year. Here we are again. A lot has changed, as we know. So much uncertainty in the world, economically speaking and otherwise. So maybe you could just start with a snapshot of how this uncertainty has impacted the commodity sector.
Well, I like how you started there. I wrote a piece recently called The Certainty That Gold Likes. One thing that gold is really enjoying, being one of the best performing major assets this year, it's enjoying the certainty of the fact that U.S. stock market's the most expensive in like 100 years versus GDP versus the rest of the world. It's enjoying the certainty of we have a new administration that's set on reducing trade imbalances, as they call them. And the certainty that inflation's running high in the U.S., partly because risk assets went up too much and created too much inflation. And there's only, so the Fed's stuck, and we also we're tilting off the fiscal. The monetary's got a problem. Gold's the only major performing assets this year. Copper's had a bounce, but it's already put in a pretty significant high for odd reasons. It looks like it's tilting back lower. Crude oil's getting crushed. Why? Because the whole world's facing tariffs. And before Mr. Trump was elected, we had these pre-existing trends that I made the mistake, I guess the mistake of pointed out in 2020 that I think crude oil was going to $40 a barrel. Now, I was an idiot then, and I'm less of an idiot now, but that's the way markets work. You have to look ahead. So now I'll end with where I think things are heading. The certainties are that we have an oversupply of the world's most significant commodity and decreasing demand on a global basis. The world's heading towards a recession if you really watch what's happening with crude oil going down and gold going up. Copper kind of stuck in the middle. And where do we go from here? That's the uncertainty. My bias is that gold continues to go higher, and a key reason for it to do that is if that U.S. stock market rolls over a little bit more.
Yeah, we'll circle back to gold. And you have these daily commentaries in the weekday. They come out in the morning. There are charts, and you're often examining the relationships of certain asset classes that you're talking about, S&P, Bitcoin, gold, oil. And like you said, for a long time, you've been saying the bias is gold at $40 at some point. And as you said,
crude
you
oil at $40.
What did I just say?
Gold.
Oil.
We'll get into
that. Oil at 40. But so meaning that you're seeing a disinflation over time, and you've been right, because now I haven't looked at oil today, but it's
$62.
62. So there you go.
WTI.
So give us a little bit more flavor on that.
Well, the WTI trend is clearly, so here's the key facts about WTI. Since it peaked at $145 a barrel in 2008, every single time it's got near 100, it's bottomed near 40. Now, there's been 4 occasions. The most recent was negative 40 in 2020. Well, we're not going there again. That was a bit of an aberration. But it's the key fact of what happens to crude oil. It's elasticity. And it's stuck in the middle of this significant paradigm shift of technology replacing it. We can create more with less, most notably from Canada and the U.S. every day with rapidly advancing technology, drilling technologies, and we use less. The fact is my plug-in hybrid EV is 11 years old. And now that same vehicle that you can get from BYD has 3 times the range of what I bought in 2014. It's much more efficient, and some of these things, it's just where things are going. We're using less, and so the key fact is you look at demand from China for crude oil, imports of crude oil. Peaking around 11 million barrels a day and starting to roll over right about the way the U.S. did around 2008, rolling over, peaking crude oil consumption. And then you look at supply, which look at supply and demand. I usually don't look at these so much, but they're just, I like to include the total excess of supply versus demand from the U.S. and Canada. Crude oil and liquid fuels, it's running 6 million, approaching 7 million barrels a day. That trajectory of the excess of supply versus demand has been one of the most significant trends in commodities for almost 20 years. And the only thing that stops it is lower prices or shocks like we had with Russia's invasion of Ukraine. So that's a significant thing what's happening in crude oil. But it's also happening it's just the technology is moving so fast, particularly the grains. Massive amount of supply from the U.S. and Canada, including canola. But what happened when Russia invaded Ukraine? It incentivized the world to produce more corn, soybeans, and wheat, particularly soybeans from Brazil. So a good example is now Brazil is on pace to export with Argentina over 110 million metric tons of soybeans. That compares to 50 million metric tons from the U.S., which has been flat for about a decade. They're doubling their production. So the quote I learned in the Midwest, I'm from Chicago, and I love going back to the Midwest, I used to own a farm, was, the old thing that saying that Mark Twain says, might as well buy some land they're not making anymore? And the quote I learned from the heartland of the Corn Belt was, they are in Brazil. So this is a wonderful thing for consumers. It's called superabundance. There's a book written about it. And that's what's happening in all the commodities. Copper's kind of stuck in the middle, but that's where we're seeing, I call it deflation in commodities. When crude oil goes from 130 in 2022 to 62 now, that's deflation from where you measure it. And the key thing is we're seeing significant deflation in China. They're facing tariffs, and their bond yields, a 10-year note yield in China today is about 1.66 compared to 4.5 or so in the U.S. and 3.5 or so in Canada, and most of Europe, much less. The rest of the world's tilting towards these deflationary trends. Commodities are heading there. China clearly has they have to have fiscal monetary stimulus to avoid deflation that we saw in Japan starting in the 1990s. I was trading Japanese government bonds there. I remember it well. And the final pillar for this deflation to kick in is U.S. stock market just reverting some of its massive gains of the last 10 years versus the rest of the world. That tilting lower means we kick into normal deflation from the inflation, and that to me is what gold's picking up on. Now, gold's a little expensive. It got to 3,500 ounces this year, but it's picking up on these deflationary trends. And to me, that's where it's, particularly in crude oil.
And a lot of fascinating points there. With gold, we did see all-time highs a few weeks ago. It's rolled over a little bit, just consolidating, correcting. Is 3,000 more likely in the near term, or 4,000?
Ask the stock market, and it's honestly true. So
yeah.
I will be. I ran over from my office this morning. I'll be publishing my latest on the gold-silver ratio. It's 100. 100 ounces of silver per 1 ounce of gold. So speaking with gold specifically, gold's at 3,300 an ounce right now. It's up 23% on the year. That's significant. Bitcoin's up only 10%. Stock market's flat. For it to stay there, I mean, it's pretty much overbought here a little bit. It's a bull market getting overbought. For it to stay here, it basically needs fuel now. It needs bull fuel. And I think the key place from that to come is the U.S. stock market tilting back downward. Now, if the stock market stays strong, that keeps the Fed out of the picture. It keeps interest rates high. And the key theme I've used for the last 4 years, or 4 years, when we've seen 4 years of outflows in gold ETFs. Now they're kicking the inflows. Was why buy gold when the stock market's on a tear and you can get 4 to 5% in a T-bill? That has changed a little bit. But if stock market stays strong, gold's going to come under pressure. Obviously, central banks are still buying. So to get gold to 3,000, I look at gold right now. It's every day it goes by, it's more of a put on the S&P 500. If the S&P 500 goes down, gold will go. I think it's going to approach that area back towards the highs for the year 3,500. If the S&P 500 continues to march higher, which I think is odd now as we tilt towards this recession that we didn't get in 2023, that'll pressure gold to 3,000. So key fact about gold: last year's high was 2,800. And here we are, 3,200. So it's a bull market, got a little stretch. You got to at least get below those levels to start worrying from a trader standpoint. But when it was at the high this year, 3,500, it was up 33% in the year. There's only 5 or 6 years in the past 100 years on an annual basis we've been up that much. And one of the most recent was 1934. That's the year after the U.S. debased versus gold. So we're getting into significant appreciation in gold. It's getting scary for what it means for the economy. So that's why I see gold, 3,000 support, 3,500 resistance. So I'll end with the key thing that can get to gold at 3,000 is the S&P 500 going to get to 4,000. S&P 500 going to 4,000, which from our Bloomberg Intelligence team says if we have a recession in this country, which is my base case, we're overdue, that's kind of the fair value for the S&P 500. If it drops to there versus almost 6,000 out, that would really accelerate gold and the S&P 500 per ounces to meet at the same level, $4,000 an ounce.
You said there was a disconnect for a while there between the price of gold at record highs and outflows of those ETFs you're talking about.
Yeah.
Now you're seeing inflows. And what about institutional and DIY investors? Are we seeing that generalist interest yet, or not really?
Oh, yeah.
It's starting to come?
Well, it's hard to measure.
Yeah.
So certainly from ETF standpoint. And so some things at Bloomberg Intelligence, I sit and I get to deal with some of the hundreds of thousands of the most significant financial professionals in the world. I don't always know what they're thinking, but I get the questions. And a lot of times you can determine a lot from the questions. I've been getting the questions lately. And one of them was a couple gentlemen said, Mike, I should have bought gold when you said 4 years ago. Well, I never said sell it, but I just said it's going up.
Yeah.
The thing I've been worried about is the rock-beating stocks for a number of years now. People are starting to pick up on that. You're seeing that in ETF inflows. So last year marked 4 years in a row from ETFs outflows. This year's been significant inflows. The last couple weeks, tilting back a little bit, flows. But to me, that's the shift from institutional investors. And one thing I've watched is futures open interest, futures managed money net positions, i.e. hedge funds. They were way overweight long for months. They've been lightening up. The hot money has been lightening up. And it's more institutional, longer-term investors getting in through ETFs. So it's also the key thing about performance. Now, gold's a little bit expensive, short term. It depends on, you look at the moving averages, RSIs, and all that stuff. But that's what bull markets do. But the key thing now, to me, the number one catalyst to get those institutions to really accelerate purchasing of gold is if that number one alternative on the planet, beta, the S&P 500, rolls back over. To me, that's eventually going to happen. It's just a question of when, and it's got to make it as difficult as possible.
Okay. Lastly, Mike, you've covered a lot of ground. What's the one key trend right now that you find the most compelling in the commodity market?
Well, it's obviously gold going up. The thing is, I'm going to be publishing really soon is gold-silver. Gold-silver ratio right now is 100. We have never closed at the end of the year above 100. The high ever was 91.5 in 1991, 1990, 91. That was a significant recession. And unemployment peaked in 1992 at 7.8%. So if you look at that gold-silver ratio, it to me is front-running a global recession. That to me is one of the most significant things I'm watching. And you look at unemployment. Unemployment's just starting to bottom from a trough. It almost always goes to 6%. Right now at 4.2%. That's just starting to move up. Volatility in the U.S. is just starting to move higher. So to me, that's a key thing I watch. I'm watching gold, crude oil, but crude oil is less significant. And the final thing I'm really watching, I'm really worried about the shoe to drop is copper. Copper's had a major year this year, mostly in U.S. tariffs. It got up to $5.37 a pound. Right now it's $4.60 or so a pound. We have a fair value model in Bloomberg Intelligence that says its fair value is around $3.90, and I'm more worried it's going to trade lower with yields in the stock market. So if copper drops, that's a sign that those deflationary trends I'm seeing from crude oil, from gold going higher, from tilts from bond yields collapsing in China, it will solidify that final leg of deflation on a global basis, and with a little bit mixing in with the U.S. stock market.
All right, you gave us a lot to think about.
Thank you.
Mike.
Thanks for having me.
Great stuff. Mike McGlone from Bloomberg Intelligence.